Hey everyone, welcome to Talking Tokens, a podcast focused on interviewing the best crypto founders, market players, and up-and-coming startups that are changing the industry every single Tuesday and Thursday. I'm Jacquelyn Melinek, your award-nominated host and former senior crypto reporter turned entrepreneur, and I'm excited to be here with you all. Now, let's get into it. Today's guest is Tom Schmidt. He is a general partner at Dragonfly Capital. Dragonfly has been around for a number of years and invested in over 150 companies across DeFi, CeFi, L1 and L2 blockchains, and NFTs, to name a few sectors. I'm really excited to have Tom on today. So Tom, welcome to the show.
Hey, thanks for having me.
To start off, I know your background. We've known each other for a couple of years, but for our listeners who don't know you, can you tell us kind of how you even got into VC, what were you doing before, and why Dragonfly?
Yeah, great questions.
Give us the life story.
Yeah. I think everyone takes a very different path into VC. I think it's certainly true of most folks at Dragonfly. For me, I started out, I studied computer science undergrad at Stanford, worked as an engineer for a little bit, eventually moved into product management. I was a PM at Instagram in kind of the early days. I was there for about 3 years. And then classically in, sort of Silicon Valley fashion, took some time off. Was kind of playing with some startup ideas, and I kind of rediscovered crypto. I had been into it during my undergrad. Just feel like people in the CS department were into Bitcoin.
Makes sense, yeah.
And then kind of fell out of it when I was working in big tech, and then kind of started getting excited about it again. A good friend of mine is actually Hunter Horsley from Bitwise.
Yeah.
And he was the one who also started kind of telling me about it and rediscovered Ethereum. Really fell in love with the vision of DeFi before DeFi, the term, was around. We didn't really know how this stuff would all kind of fit together. Ended up joining 0x and led product there for 2 years. So if you've used Matcha or 0x API and some of the fan favorites, and then got connected to Haseeb. We'd kind of known of each other. Haseeb's one of the other partners at Dragonfly. We never really connected or spoken much, but had kind of seen each other talk at conferences or do research. And we really just hit it off. I think a few things kind of connected with me for Dragonfly. One is this East-West focus that we have. So for context, we have an office in New York. We have an office in Singapore. Our team, our LP base, our investments are kind of split across Asia and kind of the West, like the US and Europe. And I saw this at 0x that Asia really is such a big part of the crypto story, but really it's a global story. It's not like traditional tech where maybe you start a company and you're only serving the San Francisco Bay Area or California or the US. If you're launching a new layer one, you're really having a global community on day one. And I think for me, from an investment mindset, it's not only accessing a global pool of companies, but it's also helping those companies think about a global go-to-market. And that's so in tune with Dragonfly's DNA from the very beginning. The other was kind of similar to me. I mean, Haseeb also had a very similar path of going into engineering, then going into venture. And I think we take a lot of that DNA of coming at investments from first principles.
The technical side,
It's a more of a technical kind of DNA to the team. And so, joined end of 2019 and been here 4.5 years. So.
Okay, that's exciting. What are you most interested in this current market cycle? And then we'll kind of talk about the regional differences and stuff, because I'm glad you brought that up.
Sure. It's a very weird market cycle is kind of the how I would describe it. I think people who've been around the space for a while, a lot of different cycles, they've had very crystal themes, right? There was sort of an ICO wave, and then there was DeFi summer, and then there was sort of this NFT consumer Web3 phase. And now it feels like we're getting kind of this mix of many different components. Part of it is this sort of institutional adoption wave with sort of the ETFs. Part of it is obviously a lot of the meme coinery. Yes, exactly. But there are also really interesting innovations happening in DeFi and in layer ones and in layer twos and in data. And so it's sort of maybe even like the market overall right now, where there's this dispersion where it's not unilaterally everything going up, everything going down, but some sort of interesting green shoots popping through. So for me personally, I think a lot of the stuff is actually kind of happening around consumer and applications. I don't think you've mentioned earlier, but we were talking before the show about Polymarket, an investment that we did recently, which has obviously been in the news cycle quite a bit. And a lot of people don't realize that Polymarket is powered by crypto under the hood. They're doing on-chain resolution. They're using stablecoins for settlement. And there's a lot of companies and applications like that right now where they have the ability to go mainstream, or they are going mainstream, and they're powered by crypto under the hood. And so I think that is something that I've been looking at a lot more recently and getting really excited about.
Do you think that is the best path forward right now? Because Polymarket obviously has seen a lot of traction. I know people outside of this industry that talk to me about Polymarket. They don't even know it's powered by a blockchain, and it's doing really well on that front. So do you think that is the best way forward to kind of like hide the technology, bake it in, and just like power apps in a way that people don't really need to know that it's on a blockchain or crypto or whatever it may be?
Yeah. I mean, coming from a product background, this was always my sort of vision of how the industry would work, even back as far as 2017, is it's sort of like TCP/IP or SMTP for email. It's just like, it happens in the background, and you don't think about it. You just open up Gmail and everything works.
Those were technical terms I didn't know.
Yeah. It's sort of like the backbone, the internet. And I was very sort of surprised in the 2020, 2021 cycle when that was like very much not the case. If you look at NFTs, for example, originally you had stuff like Nifty Gateway, which was all pretty centralized. Like you show up and you wire them money and you buy an NFT, and it's all sort of happening on their server effectively. And they quickly got passed by OpenSea, which was all very crypto native. So you have to have, MetaMask, and you have to go sign transactions and load it up with Ether. And it's very sort of, raw metal approach to interacting with stuff on chain. And that was counterintuitive to me. I would think, hey, people want sort of mass consumer. They want easy sign in with Google kind of experience. And I think this cycle has been sort of that trend going in reverse, where you look at a lot of the top sort of consumer applications, they're using things like wallet as a service providers like Privy or Web3 Auth or Turnkey to offer that sort of very seamless, world-class consumer application experience of, you give me your phone number and it's just sort of SSO, and there's no sort of crypto-y going on behind this obvious to consumers. So it seems, and I'm a bit of a, empiricist on this kind of stuff, where I think you have to kind of look at what the market is saying and respect it. And the market is saying like, that's what people are preferring now. And maybe it's a different type of person getting into crypto now than, 3 years ago. But I think that is more likely the way this goes mainstream is you just have something that looks and feels like a normal application, but allows you to do something that maybe you couldn't otherwise do.
I think for people in the crypto space too, they also just want user accessibility and like a good experience. Even if they fully understand the technology and they have a technical background, it's a good thing that they don't have to click through like 10 different pages to get a transaction done or, sign into something. And so I don't think it's just for like mainstream audiences, but also for crypto too, to make it more accessible.
Yeah, everyone wants a great consumer application. You want it to look and feel like Instagram, right? It's like not super surprising,
right?
But sometimes that is at odds with a lot of the crypto ethos around, not your keys, not your coin, or complete transparency or auditability. And it's not that these things don't have that, but they're not as sort of core to the experience. And that was something that I think has changed recently, where previously no one would even think about touching something like that. And now, and maybe it's the type of different application where, hey, if you're trading, thousands or tens of thousands of dollars, maybe you care a little more about self-custody and auditability. But hey, if you're flipping some meme coins or, sending someone a few dollars, like it's less important to the experience.
Right. Yeah. You just want to, do well.
And
get the transaction to go through.
Yes.
Right? Yeah. Dragonfly is on its third fund at 650 million, right?
Correct.
That is a big fund, and it is still being deployed. I remember when I covered it like 2 to 3 years ago, when I was a reporter. Obviously, like smaller funds have less capital spend, so they probably are a bit more conscious about how they spend it. But what do you think? Or I'm sure you're conscious about how you spend it. That wasn't good that I said that. But I guess, how does it differ opposed to small funds, first of all? And then what are you focused on in investing out of that fund? Because obviously there are other partners, people who help you kind of like diversify and like decide where to put capital. But what is your focus?
Yeah. Sizing is definitely something that I didn't appreciate as much about venture when I joined. I think on the outside, think, well, we just find the best companies and we give them some money, and that's kind of it, right?
Yeah.
And in practice, you do think a little bit about portfolio construction. So much of the work is hands-on, working with portcos, helping them do hiring and data and product and kind of all that kind of stuff. And you can only do that if you have so many portcos. If you have 1,000 portfolio companies, there's just not enough time or hours to allow that to happen.
Yeah.
And so part of it for us is thinking about ownership in the company, but then the company's how much of the company is the fund. So you don't want something that's too small, and you also want enough ownership so that if it does well, there's a meaningful outcome with respect to the size of the fund. I think it's funny you say it's big. I think when we raised Fund 3, 650 was kind of middle of the pack.
There were a bunch of big funds at the time. There was A16Z, yours, others, and
at
the time it made sense.
Yes. And so we're like, oh, well, this is great. And I think in practice, what we've seen is a lot of the growth stage stuff in crypto has become very difficult. That market has really kind of shrunk, and it's gone sort of more early stage. And I think maybe in some ways similar to like traditional finance and traditional venture. We've, I think, tried to thread that needle, and I think we've done it pretty well of trying to play in seed where we can, trying to spot things early, and then size up with those teams as they keep growing. So we can do the seed, and then we can do the A, and we can do the B. And I think that has actually mapped pretty well to how the market has gone. You're right that for smaller funds, they definitely have more maneuverability and flexibility. But the downside is that they can't necessarily keep scaling with teams as they maybe have more capital needs. And so I think the fund size has actually fit the market pretty well, which is not obvious, I think, when we raised it. The other obviously thing that has happened is just the market dynamics have changed. It used to be, hey, we have these teams that are pre-TG for years and years and years and years, and they need more and more capital, and it goes into a foundation. And now, for, let's say, a new DeFi application, maybe they raise a seed, maybe they do an A, and then they do a TG, and then they're doing a treasury diversification sale, which is very different than, maybe doing a late stage growth round in like a traditional equity business. And so that's been a shift in maybe the past 2 or 3 years, and we've also done some of those and played in some of those. But I think sizing is and timing is a large part of everything in venture. I'm trying to remember the
other question leading up to that was kind of like, what do you think your focus has been in terms of investments? Because obviously there's like a few of you who do deals, do your due diligence, et cetera. But what do you think is something that like you're either hyper focused on or really interested in investing in startups right now?
Yeah, I think for us, we actually tend to be much less thesis driven than a lot of other VCs in the space. You'll see other funds, they'll put out, some blog post with a manifesto of, hey, here's how I think this thing is going to happen. I know exactly what you're talking about. Yeah. And sometimes that works, right? That allows you to be very contrarian and do stuff early that if you end up being right, that works. Other times it's, you are like, that last, Japanese soldier on the island, and you don't know the war is over. You keep
it's
fighting this fight.
Yeah.
And it's like the market is rejecting you. And at a certain point, you have to know when you're wrong. And I think that's kind of one of the more dangerous things in venture is maybe you don't know when you're wrong. And if you don't, then you're kind of screwed. And so for us, we tend to be a lot more bottoms up of, hey, is this solving a problem that we have? Is this an app that we like to use? Is the data showing that this thing is very retentive and there's like organic engagement? Is there high willingness to pay? I think these are all kind of gold standards when we're looking at products. And so a lot of the things that we've done out of this fund, they've been sort of in those buckets. I think Athena is one that I did maybe about a year and a half ago.
Yeah, we had Guy on the podcast as well.
Guy's
great.
Was
great, yeah.
And it's one of those things where it's one of those investments that sort of gets unlocked from investment experience. We've done, we did one other company that was trying to do a similar kind of product, and there've obviously been other attempts at doing this kind of cash and carry backed synthetic dollar in the past. And they had not been successful for various reasons. One of them being, hey, this constant sort of custody risk that is now very top of mind post FTX. Part of it is, hey, what happens when funding rate goes negative? Part of it is, hey, there's just not enough open interest in the space in order to make this thing grow. And having Guy and Athena and us took those lessons and used those to inform Athena. And so now we don't have the custody risk because you can use third-party custodians and you can have a tri-party agreement. And so you don't have that same sort of risk that existed 2 years ago. And now you have things like liquid staking derivatives. And those didn't exist 2 years ago. And that sort of provides this constant yield that offsets potential negative funding rates. And now, hey, you can tap into Sunrise Exchange open interest, which is orders of magnitude larger than, decentralized perp interest. And that was not a thing 2 years ago. And so if you weren't in this space 2 years ago, looking at what was happening and taking those lessons, you sort of miss out on the next wave of opportunities.
Yeah. Did Dragonfly invest in Fantasy Top?
I don't.
Or you're just like personally interested in it?
I don't think anything's been announced yet, so I don't know. But I do love Fantasy Top, the product. Yeah,
that's a political response. But I remember the reason I brought it up is because when Fantasy Top first came out and it was like very popular, I remembered like messaging you saying like, I don't get it. And that's because I am not a fantasy football person. I don't know that type of game, but it got traction initially. So obviously you saw some value in it because you were tweeting about it. Yeah. But where do you kind of see like consumer applications going? Maybe on that front where it's engaged and you have people betting on things, to something that, again, going back to like the conversation about mainstream audiences, where it appeals to the masses in a way that maybe isn't so crypto native. I think Fantasy Top was kind of crypto driven, but
yeah, I think they're very much leaning into
you had to
the
like have
Twitter
Ethereum
crowd.
And everything. Yeah.
But I think there's a category of applications that I would say are sort of stablecoin powered, in that not necessarily all the logic is on chain. I think people have in some ways shied away or been more pragmatic with respect to which logic is part of a smart contract and what is happening off chain. But they're using stablecoins to basically have instant, transparent, programmatic payment and accessibility, and that's something that's very novel. This also in turn is there's sort of this meme from Silicon Valley in that, hey, part of the difference between the IPO or the .com bubble and sort of the 2000s was you went from having to buy your own server racks and install them, and there's this huge upfront cost which inherently limits the number of competitors in the market and therefore the number of good ideas to you can rent a box on AWS for $5 and start with just an idea and scale it pretty quickly. I think stablecoins provide a similar kind of process where you can build something that needs some sort of payment or some sort of money rails, but you don't have to go through this entire crazy onboarding process with traditional payment providers. You can just accept stablecoins and you're ready to go on day one. I think Fantasy Top borrows from some of that, but also it sort of plays into this idea of the increasing, mainstream adoption and acceptability of gambling as a form of entertainment. Obviously, sports betting has gone crazy in the US in the past few years, but we see people want to gamble or bet on other types of things as a way of entertainment. And I think social media, obviously, as a percentage of time spent, as a percentage of overall media consumption, has gone crazy. But that these two sort of trends are sort of divorced from each other. And so I think fantasy is attempting to marry these two of, hey, well, you're already on Twitter or Instagram or TikTok and you're following someone that you really love and maybe you spot somebody early, why not be able to sort of, wager on, their popularity and sort of use that the same way you would for, a sports game for entertainment.
Yeah, no, that would make sense. I guess on the front of regional differences, you talked about this in the beginning. Do you find that like what people in the West want versus the East differ a lot? Because I was in Korea last year for Korea Blockchain Week, and I felt that it was vastly different from the conversations I'm having in the US and even Europe compared to what Asian markets are looking at. So from an investor perspective, obviously you're talking to a lot of startups. Do you find the same thing that I'm talking about, or is it really a global similarity across the board?
There is still localization that has to be done, I think, if you want to go into these markets. Not just basics around different types of interface design or basic sort of internationalization of strings, but also different technology choices, different preferences around how people access things. When you look at something like Meituan or like Alibaba, and like it just looks way different than like a US e-commerce site, for example. I think there's also just different regional strengths. I think historically, and still true today, Asia has just been much more innovative when it comes to centralized finance. And part of that is part of the regulatory situation in the US, but part of it is just the way the ecosystem developed out there. A lot of it came out of Bitcoin mining back when it was in China, and then the need for financial services for Bitcoin miners, that evolving into things like lending, brokerage, a lot of the evolution of exchanges, and just the ability and willingness to take more risks there. And I think that's still today why you see Asian exchanges still be so dominant globally. I think when it comes to hardcore sort of deep R&D. A lot of it's still coming out of kind of the US and Europe. But I think that's starting to change. I think we're seeing some good teams come out of Asia. And part of that is also just due to the startup ecosystem in China, as we've sort of seen, China has obviously been struggling with, or their tech sector has been struggling in the past few years for various reasons. And that kind of goes all the way upstream to venture capital as well. And US firms thinking about how much exposure do we want or need, or can we allow in China? And that sort of decoupling, that obviously downstream means, hey, there's fewer job openings for engineers or designers or marketers. And these people are still very talented. They still have great talent, but there just aren't openings for a lot of domestic tech companies. We see a lot of those people looking to explore Web3 as a way to build a global product and tap into global capital markets. And so I suspect that trend will probably continue, depending, again, on what happens in sort of the Chinese tech ecosystem. But there definitely are talent flows. And I think that to a certain extent determines how startups get formed.
Do you think the institutionalization of crypto is playing an impact on that as well? Like we see in Hong Kong, they've got, some institutional involvement as well as like ETFs, and same with the US, we've got the ETFs here. And then in Europe, they've got like MiCA and other things. How does that kind of contribute to all this? This podcast is sponsored by Galaxy. If you're immersed in the world of Web3, Galaxy is a name you need to know. As a decentralized super app with an impressive 21 million users boasting over 100 million monthly transactions, Galaxy is elevating its impact with Gravity, the magnet chain for Web3. Gravity is designed for full chain abstraction, zero knowledge proof-based privacy, and rapid transaction speeds, all coming together to offer an unparalleled user experience. Gravity opens the door for developers to effortlessly build on the largest on-chain distribution platform, and for users, it promises an even smoother, more secure journey through Web3. It's not about being on-chain, it's about being on the right chain every single time. Galaxy is on a mission to onboard the world to Web3, and Gravity is the magnetic force that will propel the vision forward. Ready to launch your Web3 journey? Build the future on Gravity. Visit gravity.xyz for more information.
Yes and no. I don't think the Hong Kong ETFs have been super successful. I think
they exist.
They exist. If you're wealthy and Chinese, you probably have some sort of access to offshore banking, or probably some sort of way to get access to Bitcoin or Ether or whatever sort of crypto investment that you want to make. And so it's not as big of a unlock necessarily, or sort of this whole ETF brokerage, retirement account ecosystem isn't quite as strong there. But certainly people look to the US regardless. And I think the sort of tacit endorsement of these assets by a result of the ETF approvals makes these things look more attractive, and allows people to underwrite them to their own partners or investment committee, or maybe just themselves. And there's always sort of this meme that that the price is the product. And there is this weird sort of convexity where when the price of Bitcoin or ETH goes up, suddenly builders get maybe a lot more excited about building in the space. Maybe the TAM looks a lot larger. Maybe it looks like a better investment. And so, for better or for worse, I think that obviously does impact the perception of the industry and how much entrepreneurs want to come into it. But I think to your point around MiCA too, I think this has been sort of the rallying cry for US builders is they just want clear legislation. They want clear guidelines and boundaries, and just they know where the limits of the sandbox are. Other countries are providing that, and we see oftentimes that's a competitive advantage for teams that want to offer something that is just too much in a gray area in the US. Well, I know it's in the white area in Europe, so I'm just going to do it there. I would love to see that happen in the US too, but right now there's just so much gray space.
Not to shift gears here fully, but we talked about before the size of Dragonfly's third fund. And a question I wanted to ask you was, do you kind of see the crypto VC market kind of going back to the 2021, 2022 size? Like, I'm pretty sure the capital invested that year was about 14 billion or 10 billion. It was a big number. And right now it's not at that. Do you see a world where we go back up to those levels? Or is it just like we're cruising in the low billions and we're enjoying it?
Yeah. Well, we're definitely enjoying it right now.
Yeah, you're happy.
Yeah. I think, it's a little bit of tail wagging the dog, where if there are opportunities in late stage that can take that kind of capital, then I think funds will be able to raise funds to go after those opportunities. Right now, we just haven't really seen those. It's a lot of later stage equity investments. Well, the IPO market is still frozen in the US. And so until there's a path towards liquidity and exit for those, it's harder for those companies to go and take in more capital for a VC to underwrite them. I think also we've sort of seen this, again, speaking of sort of dispersion, I think LPs are also starting to understand and separate crypto from crypto VC. I think if you went back, 7-8 years, a lot of people think of crypto as one bucket and they give money to a fund manager, and that fund manager maybe buys some Bitcoin, maybe buys some ETH, maybe buys some altcoins, does some venture investments, and like that is kind of the bucket. Now, I mean, maybe again as a byproduct of the ETFs, but also even prior to that, it's become so much easier to just go and buy Bitcoin or buy ETH yourself.
Right.
And that means for VCs, hey, if I'm trying to outperform these as benchmarks, I can't have these in my fund. And so I'm looking for new opportunities in other assets or other investments. And so the return profiles of these are correlated, but not one-to-one. And there's no sort of guarantee of outperformance or anything like that. And so I think LPs are also trying to bucket these in different groups. So I'm not sure how that's going to impact sort of upstream capital flow, but again, it's sort of, hey, if we see those later stage opportunities, that in turn sort of makes it more attractive as a capital allocator.
Yeah. What % of your investments do you say are early stage, like let's say pre-seed, seed, to later stage from Series A on?
Do you mean as like a percentage of like capital weighted, or in terms of
like the amount of deals you do?
As just a number of deals, it's definitely more early stage heavy, right? You can write more $3 million checks than you can $30 million checks. But those obviously then turn into things that need capital down the line. So we do a seed, and then we'll put in, maybe another 10, 15 at the A, and then maybe another 20, whatever at the B, or maybe we just do a pro rata. And so I think there's definitely a weight where maybe, let's say 50, 60% of those companies are early stage, but then capital weighted, it's much more shifted towards later stage, or maybe a seed that has done well and turned into a larger percentage of the portfolio. Going back to something I was mentioning earlier, we also try to limit the number of investments in the portfolio because we do so much work with existing portfolio companies. So we have a 4-person talent team that does a lot of hiring assistance and coaching and sourcing. And there's only so many companies that they can work with. And so that sort of places a limit on how many companies we can have in our portfolio, for example. And so there's this weird sort of, again, counterintuitive dynamic in venture where if you're investing out of your PA, maybe you'll have a diversified, basket of assets, or you'll be like, hey, I just put some money into this thing and maybe it does well. Or maybe you see something that can be a good investment. Maybe you think, hey, I think this can be a 4 or 5x, which is an amazing outcome. But in venture, those don't fit into the portfolio necessarily. Every single investment has to have the potential to be a fund returner. And so we see a lot of opportunities where maybe we think it's a good business, but not something that can be a fund returner, or something that is great, but maybe too small for the portfolio, or something where we just don't think maybe the best outcome is still not something that's going to be meaningful in the context of the fund. And you have to decline those and turn those down, which is painful and, again, counterintuitive as an individual, but just doesn't really fit the venture model.
What would you say are some of the best investments you've made while at Dragonfly?
Good question. I think a lot of it, again, kind of comes back to spotting things early that we really love and think solve our own individual problems. So Dune, for example, Dune Analytics, they're one of the leading.
I like Dune.
Yeah, leading.
I use Dune.
I use Dune. Great. And that was actually part of the genesis. Is I met those guys back when I was at 0x. Was a big data nerd. Was really big Dune user, and ended up leading their seed back in, I guess, early 2020. And since then they've had an amazing journey, become kind of like the de facto name as far as crypto analytics. But it comes back to a company that we love and a product that we love, and just backing those and sort of helping them on their journey. 1inch being another one. I sort of led this whole aggregator initiative when I was at 0x, and sort of saw this trend towards aggregators in the DEX space. I met the 1inch guys actually at ETH New York back in 2018. I was like a judge. New York? Yes.
Wow.
They still have those. I don't know if they're as popular as they used to be.
They're like small, yeah.
Yeah. So this hackathon, they're working on one inch. I was like, great. Ended up joining Dragonfly and led their seed as well. And so now they're like one of, or if not the leading DEX aggregator. So things like that. Athena being another more recent one. So again, a lot of it comes down to products that we know and love, or that are solving a problem that we have, or a portfolio company has, or something that it just kind of intuitively makes sense. I think a lot of those end up being a lot of the best ones. It's sort of like the don't overthink it meme, you know?
Yeah. That made me want to ask another question about kind of like, if there are a lot of startups or teams working on things that already exist, like what came to mind is like, we have a lot of L1s, we have a lot of L2s, but yet investors continue to invest in them because they're going to like reinvent a certain part of the wheel, but not the whole wheel, or they claim they're going to reinvent the whole wheel. How do you kind of determine when there's so many of one specific category, okay, this one's actually worth investing in on top of the other ones we've already invested in?
Yeah. There are certain categories where we sort of take a wait and see and pay approach, where it's not obvious. There's a lot of great teams and we think it's a great market. But a lot of these things maybe have very positive network effects or virtuous cycles. And so you can take a bet early, but if someone else starts running away with the market, well, that's probably going to be the winner. And so sometimes we'll wait and see who ends up, kind of running away, and then a little bit, and then backing them. But it's not intuitively, obvious at the outset where that winner is going to be. I think for other examples, there are a lot of not like copy paste, but sort of X on Y kind of projects right now, where it's it's almost Mad Libsy, where it's like we're going to take this language and this consensus and this market, and we're going to mash them up all together. And a lot of it comes down to, at the early stages, the founders and why are they doing this? What is their thesis? Why are they so convicted on this particular solution to the problem? The solution can often change and often does. I think Say is a very recent example. We're not investors, but when we met them initially, they were building this sort of order book. There's this Cosmos-based chain that like a native order book. It's like, okay, kind of an interesting idea, not something I have super high conviction on. And they've since basically pivoted in this parallel EVM story, which we were investors in Monad that we really love. And I think having seen the evolution of the EVM and sort of underwriting it as almost this sort of JavaScript type of solution, where it's not the best product in the world, but there's so much density and inertia around it that the way we evolve is by making it better versus trying to rip it out and do something entirely new.
Yeah.
I think there are approaches that can work to that. I think obviously we're investors in Aptos, which you mentioned, and they have an entirely different VM, entirely different language around Move, which I think also solves a lot of those problems, but it's just a very different approach. And so maybe going back to your original question, oftentimes it is like the weirdest, least desirable investments that end up being some of the best ones. Like I don't remember like Dune or Orange being particularly competitive because it was so sort of off consensus at the time.
Yeah.
And for other opportunities, I think we, VCs can obviously post hoc make up some story around here's why it was so obvious that it was going to win. But I think a lot of the winners, even from this past cycle, were not necessarily obvious at the time. And
you knew what was cool before it was cool.
Yeah. Only sometimes.
Yeah. But do you think some of the really big rounds, like you mentioned Monad, it's like overhyped, not specifically for them, but when there's such a big round, it's hard to keep up that momentum when they actually do launch the product that they're planning to launch, whether it's a chain or something else. Yeah.
There is this sort of low float, high FDV meme going around. And I think
we love the memes.
I love the memes. I feel like I said meme a bunch of times on this. But it is kind of a meme. It spreads on crypto
culture,
Twitter. And I think in practice, this cycle is not actually that meaningfully different from other cycles in terms of what does the float launch at the top. It's going back to kind of the point we were talking about around later stage venture investing. It's like, well, if that's what the market is rewarding, to a certain point, you have to respect that as an investor and learn from it and listen to it. And so, hey, if the market is really rewarding new layer ones or layer twos or bridges or whatever that are doing well in the public markets, well, as a VC, that's something I can underwrite to in terms of comps. And so I think unless that market dynamic shifts, which it very well could, I think we could see a shift back to applications as we're kind of seeing now. And a lot of these applications also monetize incredibly well, which is maybe different than a lot of other L1s. I don't know if sort of venture markets are going to change meaningfully in that regard. So it's sort of like you be the change you want to see in the world. It's like if the public markets change, I think the private markets will also change, but there's that lag period in between.
Inspirational.
Yeah.
Very, very. On the front of founders, last major question in this like little segment, but what do you look for in a founder? Because obviously you might meet a lot of really, really smart people with amazing ideas, but they might really put you off.
Yes.
Right. And then the other side where it's like, oh, their idea wasn't that great, but I really love the founder.
Yeah.
So what do you look for?
Really depends on staging. I think for something in that early stage, pre-seed, seed round, like as you mentioned, the product and often the market is going to change. It's really a question of who is this person and what are their motivations for doing whatever it is that they're doing. Startups are very hard and times can be very tough. And you want somebody who is extremely motivated by whatever it is that they're trying to solve, such that they're going to stick out the tough times and be willing to keep iterating and shipping and trying new things and sort of stick with it through all times. You also obviously want people who, I think there's sort of this founder stereotype, people who are very charismatic and can build a team around them. That's a large part of your job as a founder is hiring. And the best founders are often the ones that not just have some sort of technical insight or are really good at product, but can also recruit people who are maybe even better than them around them and get even more A players in. And founders that can't hire well, oftentimes like that is sort of a lot of the issue with the team is, sort of the talent quality degrades. So for us, those are a lot of the two big things that we look for. And then there's this idea again of founder market fit of, is this the right person to tackle the problem space that they're going after? I weight this a little bit less because I think in crypto, we've seen, this is actually I think, not a very strong indicator for success. A lot of the best winners in crypto, the founders have very idiosyncratic backgrounds and profiles. Like Hayden from Uniswap, I think, you look at him, back in 2018 and he's a smart guy, but very, very different, background than maybe what you would expect for somebody who's building, financial infrastructure. Right? Yeah, exactly. But obviously he's built an amazing team, an amazing product. And so, I think there's some markets you maybe weigh that a little bit more if somebody's trying to do something that is selling to institutions or traditional finance players, and you need to be able to speak their language and kind of sell to them a little bit more directly. But other things, it's sort of those other components, and I think those are often the largest predictors.
I like that. I can appreciate that. I feel like who a founder is much more important than like the pedigree they have or where they came from. Because like, I don't know, you could see a lot of really great Harvard grads not go on to do much, but that's apparently Harvard sometimes is enough, especially in like the fintech space. I feel like they'll really just invest on like a title opposed to anything else. Yeah,
there's been this. It's very funny. I've been in tech, I guess, for a while, and I remember when I first went to school. Like computer science and startups were so small. There was like a very niche group of me and my friends who were like doing computer science and maybe programming, and we love startups. And then it's really just blown up into this big, very prestigious industry. And people sort of talk about how getting into YC is almost like doing the new MBA or like doing the new McKinsey. And I think that's good and bad. Like it's great to see more capital and more talent going into the space, but ultimately you want people who are willing to be contrarian and not do stuff for social prestige and just do stuff because they're passionate about it and they love it. And I think that's usually where you get all of the best outcomes. Yeah.
I find that some of the smartest people I talk to like have no social presence.
Yes.
And like they're still doing well.
Yes.
I saw a meme, the Turkish guy with the gun where it's like technical founder, 25 IPOs, and it's like him versus like the lady with the whole eyeglass thing. Yeah. Anyways, I'm diverging from the conversation.
We love memes.
Exactly. Very meme focused. Do you think there are other sectors that is not getting enough attention right now in this market cycle, whether it's on the building front where you wish there were more people focused on creating a solution for X, or even for investors like, hey, we're really not investing enough in this?
I think, again, I think one of the common refrains on crypto Twitter is like, people want more applications? Why aren't VCs backing more applications? I think.
Why aren't they?
Yeah, good question. I mean, again, going back to you have to respect the market.
Yeah.
What is the liquidity and exit profile for an application? Today, there aren't a whole lot of great paths. Maybe that will change in the next 2 years. Maybe in the US, the IPO market will open back up. Maybe there will be more regulatory clarity around how does an application issue a token that isn't a security. But today, it's there isn't sort of that path to liquidity. And as a VC, obviously we have a very long holding profile, years and years and years and years. But there does need to be some sort of story that we can underwrite that says, hey, here's how we get liquidity on this investment. I think that will change. And I think, if anything, it makes me bullish on the application space because they're monetizing so well. You look at products like Telegram bots, for example. I don't necessarily love the whole meme coin space. It's whatever. I'm not going to disparage it.
Right.
But
sure.
You look at the Telegram bots and these things monetize incredibly well, making tens of millions of dollars a month in revenue. But hey, how does that as a VC?
Yeah. How
what is
you
eventual
invest in that?
Yeah, it's unclear. And I think there's that sort of gap between willingness to pay, clear consumer demand, but as an investment, it's less sort of clear where the outcome is going to come from. I think that will bridge. Like that just feels like there's a vacuum there that has to get filled. So I think it's not so much that people don't want new applications. I think a lot of the new applications that are coming out are doing quite well. But a lot of them probably don't even need venture dollars if they're monetizing this well. But two is for VCs, I think they need a clearer story around how do I actually get an exit on this particular product. I think beyond that, I think if anything, there's spaces that are over allocated. Where I think things like DeepIn or decentralized AI, they're interesting ideas. I, as a VC, again, you want to see sort of signs of PMF or clear demand, especially for something later stage that needs a lot of money. And I just have not really seen a lot of that yet. I think that could come. I don't want to write off the entire sector, but again, kind of taking that empiricist mindset, it's like, well, like where are the buyers? Where's the ability, the willingness to pay? And I have not seen that in spades yet, or at least to the amount that would warrant some of the valuations that we see on the market. So maybe that requires more R&D, and maybe that's the story of why we're putting VC dollars into this sector. I could be wrong, but it feels more exploratory in terms of overall maturity for the sector compared to where the dollars are going.
Yeah. My last two major question I ask every guest this: what is something that we haven't discussed that you're paying attention to that you think others should as well? That's the first one, and we'll get to the next.
That is a good question. I guess going back to that space, I think what's happening right now around sort of the iGaming space and its intersection with crypto is very under the radar. Again, partially because a lot of VCs can't invest into game or companies that do some sort of gambling or gaming. And yet these companies make insane amounts of money on the orders of hundreds of millions or billions of dollars a year.
Why can't they invest in them?
A lot of them have restrictions in their LP agreement that say you can't invest into companies that do any sort of gambling. Even though these are, it's a good question.
There you go.
Even though a lot of these are, buttoned up, they have the right licenses, they're doing, KYC, AML, they're functioning like, very normal companies. It's not fraudulent in any way. But there's sort of, again, this gap between available capital and maybe demand for capital. And I think that will probably get normalized at some point again in the next few years. So I think there's a lot of opportunities in that space. It feels like we're kind of in the 2014, 2015 era of crypto exchanges where you have some stuff that's kind of, it's maybe not the best product or maybe not the best buttoned up, but it's slowly getting more professionalized and the products are getting better. And I think the market will wake up to that over the next few years. But right now it feels kind of slept on. Okay.
We'll pay attention to that. And lastly, Tom, can you leave us with a piece of advice?
Piece of advice. I was actually thinking about this recently. I went on Up Only, which was Kobe's podcast a few years ago.
Yeah, I remember.
This. And the thing I said, maybe I'll go with it again, was make sure you're getting enough sleep. I see a lot of people in crypto who are very sleep deprived. And it's one of those things where you don't realize that you're sleep deprived. And so people keep, functioning and pushing ahead. And like, it really wears down your cognition and you don't even realize that. So get enough sleep. That's my that is my advice.
Maybe. How much are you sleeping?
I try to get 8 hours and try to be very
so at least you're practicing what
very,
you preach.
Exactly.
All right, perfect. Well, thanks so much for coming on the show, Tom.
Thanks for having me.